January 15th, 2026, isn't just another date in the superannuation calendar, it's the activation point for 7 regulatory changes that collectively represent the most significant shift in how superannuation operates since the introduction of pension freedoms a decade ago. What makes this date particularly important is that these aren't minor administrative adjustments. These are substantive changes to contribution timing, earnings coverage, compliance enforcement, and member protections that will affect millions of Australian workers and retirees. Some of these changes benefit workers directly through increased contributions. Others benefit workers indirectly by strengthening the integrity of the system. A few create compliance challenges that could affect how employers manage payroll. Understanding what's changing and how it affects you depends entirely on your circumstances, whether you're employed, self-employed, approaching retirement, or already drawing down your super. We are on a mission to reach 10,000 subscribers to build a community that is aware of these financial shifts. If that resonates with you, hit subscribe. Let me walk you through each of these 7 changes, what they actually mean in practice, and who benefits most from their implementation. The first and most significant change is the introduction of payday superannuation. From January 15, 2026, employers will be required to pay superannuation contributions at the same time they pay wages, rather than quarterly. This fundamentally changes the cash flow and timing of super contributions. Under the previous system, employers had until 28 days after the end of each quarter to pay super. This meant that super contributions for wages paid in July, August, and September weren't due until October 28th. For wages paid in October, November, and December, super wasn't due until January 28th. This quarterly payment cycle created several problems. First, it meant significant delays between when you earned the income and when the super contribution was actually made. If you were paid on July 1st, your employer had almost 4 months before they needed to pay the super on those wages. During that time, you weren't earning investment returns on money you'd technically already earned. Second, the quarterly system created cash flow challenges for some employers who would accumulate 3 months of super liability before needing to pay it. Third, it made it easier for non-compliant employers to fall behind on super payments because there was a substantial lag between earning and payment. Payday super eliminates these problems. When your employer pays your wages, they must pay your super at the same time, or at least on the same payroll cycle. If you're paid fortnightly, your super must be paid fortnightly. If you're paid weekly, super must be paid weekly. The practical benefit for workers is immediate. Your super starts compounding from the moment it's paid, rather than sitting in your employer's accounts for up to 4 months. Over a working lifetime, this earlier compounding adds substantial value to retirement balances. Industry Super Australia has modelled the impact of payday super and estimates that for a 25-year-old worker on median earnings, the change will add approximately $6,000 to their super balance at retirement purely through the earlier compounding effect. That's not additional contributions, that's the investment return benefit of having contributions made months earlier over a 40-year career. For younger workers, the benefit is most pronounced because they have the longest time for that earlier compounding to work. Payday super also improves transparency and compliance. When super is paid with wages, workers can verify much more quickly that contributions are being made. Under the quarterly system, you might not realize your employer hadn't paid super until 3 or 4 months after the quarter ended and you checked your super statement. With payday super, if contributions don't appear within a couple of weeks of your pay, you know immediately that something is wrong. This faster detection means issues can be addressed quickly rather than accumulating over quarters or years. For employers, payday super represents a significant change to payroll processes and systems. Many businesses will need to upgrade their payroll software to handle the new payment timing. The cash flow impact is mixed. While employers no longer get the benefit of holding super contributions for up to 4 months, they also no longer face large quarterly super bills that can strain cash flow. The super obligation is spread evenly across each pay cycle, which for many businesses actually makes budgeting and cash management easier. The second major change expands the definition of ordinary time earnings for superannuation purposes. From January 15, 2026, superannuation must be paid on a broader range of payments and allowances that were previously excluded or ambiguously covered. The specific expansion includes certain overtime payments, allowances paid for particular skills or qualifications, and various loadings that compensate for working conditions. This change primarily benefits casual workers, shift workers, and people in industries where allowances and loadings form a significant portion of total earnings. In sectors like healthcare, where nurses receive shift penalties and various allowances, or construction, where workers receive multiple site allowances and skill-based payments, this expansion means super will be paid on more of their total earnings. For a casual retail worker receiving penalty rates for weekend and evening work, those penalty payments must now have super paid on them if they weren't already covered. The practical impact varies by employer and industry. Some employers have already been paying super on these earnings components voluntarily or because their enterprise agreement required it. For those employers, January 15th doesn't change anything. For employers who had interpreted the previous rules to exclude certain payments, this change means additional super costs. For workers at those employers, it means higher super contributions going forward. The compounding benefit of this change, like payday super, is most significant for younger workers. If a 30-year-old casual worker receives an additional $500 per year in super due to expanded earnings coverage, and that compounds at 6% annually over 37 years until retirement at 67, that $500 annual increase adds approximately $75,000 to their retirement balance. The younger you are, the more valuable this change becomes because of the longer compounding period. The third change involves enhanced superannuation guarantee compliance and enforcement. The Australian Taxation Office has implemented new systems and processes for detecting and acting on employer non-compliance with super obligations. These systems use automated data matching between employer payroll reports and super fund contribution reports to identify discrepancies quickly, where previously it might have taken quarters or even years for the ATO to detect missing super. The new systems can flag issues within weeks. This change benefits workers by protecting their super entitlements more effectively. If your employer isn't paying super correctly, you'll know sooner, and the ATO will act faster to recover the missing amounts. The Superannuation Guarantee Amnesty that ran until September 2020 allowed employers to voluntarily disclose historic non-compliance with reduced penalties. That amnesty is long over, and the new enforcement regime has no tolerance for ongoing non-compliance. For compliant employers, this change creates no additional burden. For employers who have been cutting corners or struggling with super compliance, January 15th marks a turning point where detection and enforcement become substantially more rigorous. The penalties for superannuation guarantee non-compliance remain severe. The super guarantee charge includes the missing super amount, interest at 10% per annum, and an administration fee of $20 per employee per quarter, and none of it is tax-deductible. The fourth change introduces improved fee and performance transparency requirements for super funds. From January 15th, funds must provide clearer, more standardized disclosure of fees and must present performance data in ways that allow meaningful comparison between funds and investment options. This builds on previous transparency reforms, but goes further in requiring specific standardized formats and metrics. The benefit here is primarily for members who actively manage their super. If you're comparing funds or investment options, the standardized disclosure makes it easier to assess true costs and historical performance. You can more readily identify whether your fund's fees are competitive and whether its investment performance justifies those fees. For members who don't actively engage with their super, the improved transparency doesn't directly help unless it prompts them to review their arrangements. The transparency requirements also extend to retirement income products. Funds must provide clearer information about how different retirement income strategies affect longevity of savings and income levels throughout retirement. This helps members approaching retirement make more informed decisions about whether to take lump sums, establish account-based pensions, purchase annuities, or use hybrid strategies. The fifth change strengthens protections for superannuation in pension phase, particularly around income stream compliance. The ATO has tightened the requirements for account-based pensions and other retirement income streams to ensure they meet the regulatory standards that qualify them for tax concessions. Account-based pensions in retirement phase are tax-free environments, meaning investment earnings aren't taxed, and payments to members over 60 are tax-free. These substantial tax benefits are conditional on the income stream meeting specific regulatory requirements. From January 15th, The ATO will be monitoring compliance more closely and acting faster when income streams don't meet requirements. This includes ensuring minimum annual payments are made correctly, that commutation rules are followed, and that income streams aren't being manipulated to gain tax benefits improperly. For retirees with compliant income streams, this doesn't change anything. For those with arrangements that don't quite meet requirements, there's increased risk that the ATO will identify the issue and potentially remove the tax concessions. This change benefits the integrity of the superannuation system by ensuring that tax concessions go only to genuinely retirement-focused arrangements. It protects compliant members by ensuring others can't gain unfair advantages through non-compliant structures. The sixth change improves portability and consolidation of superannuation accounts. The ATO's superannuation account matching system has been enhanced to identify duplicate accounts more effectively and to make consolidation easier for members. When you change jobs, if you don't nominate a super fund, your new employer must pay your super into your existing fund if they can identify it through the ATO system, rather than opening a new account. Multiple super accounts are a significant source of unnecessary fee erosion. Each account typically charges annual administration fees and potentially insurance premiums. If you have 3 super accounts, each charging $200 annually in administration fees, that's $600 per year being deducted from your retirement savings for no benefit. Over 30 years, that $600 annually represents roughly $50,000 lost to duplicate fees, accounting for investment returns foregone. The improved portability system reduces the likelihood of accumulating duplicate accounts unintentionally. The enhanced consolidation tools make it easier to identify and merge accounts when they do exist. For younger workers who change jobs frequently, this change is particularly valuable because they're most at risk of accumulating multiple small accounts throughout their careers. The seventh change relates to insurance within superannuation and the continuation of reforms that began in 2019 to prevent inappropriate insurance erosion of low balances. From January 15th, super funds must apply stricter rules about when insurance can be provided automatically and how premiums are charged, particularly for younger members and those with low balances. The 2019 reforms, known as Protecting Your Super, stopped funds from providing default insurance to members under 25 or with balances below $6,000 unless the member actively opted in. These reforms recognized that automatic insurance in super was causing substantial erosion of young people's accounts through premium deductions, often for insurance they didn't need or know they had. A 22-year-old with a $4,000 super balance paying $300 annually in insurance premiums would see their balance decline rather than grow in years without contributions. The January 15th changes extend these protections by tightening the rules around how insurance is offered and making it easier for members to compare insurance costs and cancel unnecessary coverage. The benefit is that fewer people will experience their super balances being eroded by insurance premiums that don't provide value for their circumstances. For people who need and want insurance through super, the changes don't prevent them from obtaining it. They simply require more active engagement rather than passive default coverage. What ties these 7 changes together is a consistent theme, moving superannuation from a passive, set-and-forget system to one that requires more active engagement but provides better protections and more timely benefits. Payday super means your money works for you sooner. Expanded earnings coverage means more of your total income generates super. Stronger compliance enforcement means your entitlements are better protected. Improved transparency means better informed decisions. Enhanced pension phase oversight means tax concessions are properly targeted. Better portability reduces fee erosion. Insurance reforms prevent inappropriate erosion of young people's balances. For most workers, particularly younger workers and those in casual or shift work arrangements, these changes are unambiguously positive. You'll receive super faster on more of your earnings with better protection against employer non-compliance and with reduced risk of duplicate accounts or unnecessary insurance eroding your balance. The compounding effect of these benefits over a 30 or 40-year career is substantial, potentially adding tens of thousands of dollars to retirement balances. For employers, these changes create compliance obligations and system upgrade requirements. Businesses need to ensure their payroll systems can handle payday super timing, correctly identify which earnings components require super, and meet the enhanced reporting requirements. For compliant employers with modern payroll systems, the transition should be manageable. For businesses using older systems or manual processes, January 15th represents a forcing function to modernize. For retirees already in pension phase, most of these changes don't directly affect, though the enhanced transparency around retirement income products may help you better understand your existing arrangements and whether they remain optimal for your circumstances. The pension phase compliance tightening is relevant if you have complex arrangements, but standard account-based pensions operated through major funds should already be compliant. What January 15, 2026 represents ultimately is the Australian superannuation system maturing from its growth phase, where the priority was getting contributions flowing and balances accumulating, into an optimization phase, where the priority is ensuring the system operates efficiently, protects members effectively, and delivers its intended retirement income outcomes. These 7 changes are part of that maturation, addressing gaps and weaknesses that became apparent over the system's first 3 decades of operation. The question of how these changes help you depends on where you are in your super journey. If you're young and early in your career, the combination of payday super, expanded earnings coverage, and better account management will add meaningfully to your retirement balance through compounding. If you're mid-career with established super, the transparency and compliance improvements help ensure you're not being disadvantaged by high fees or employer non-compliance. If you're approaching retirement, the improved retirement income guidance helps you make better decisions about how to structure your super in pension phase. What remains constant is that superannuation continues to be central to retirement planning for most Australians, and changes like these 7, taking effect January 15th, shape how effectively the system delivers on its core purpose, providing income in retirement to supplement or substitute for the age pension. Understanding what's changing isn't just about compliance. It's about recognizing opportunities to maximize your super within the evolving regulatory framework and ensuring you're positioned to benefit from protections and improvements the system now provides.